Hello, everyone, and thank you for joining me at this regional Middle East and North Africa macroeconomic outlook overview. My name is Robert Besseling from Pangea-Risk, a specialist intelligence company providing analysis and forecasts on political, economic, and security risk in Africa and the Middle East. I am delighted to present to you some snapshots of our analysis and risk forecasts for the MENA region, while also revealing some trends that I find particularly exciting for export and investment opportunities going forward. While COVID-19 cases and Delta variant infections are surging across the world, the 410 million people who live in the Middle East and North Africa region have not been spared. Governments in the MENA region initially reacted rapidly to contain COVID-19. Strict containment measures helped to limit the first wave and have since gradually been lifted. However, the situation now appears to be diverging. While Gulf countries seem to have flattened the infection curve, the public health situation appears much more fragile elsewhere in the region. Uneven access to vaccines and the emergence of COVID-19 variants could also derail the region's recovery, as prospects for wealthy and poorer countries diverge. Overall, Pangea-Risk readings of 19 MENA countries, including Turkey and Israel, suggest intra-regional differences in response to the COVID-19 pandemic. To a large degree, these reflect differences in the GDP per capita levels of individual countries and the quality and resources of health systems and public administrations. High-income Gulf Cooperation Council, or GCC countries, and Israel have been doing much better than most of their middle and low-income neighbors, although there have been some positive exceptions among the latter, for example, in Jordan and Morocco. In the MENA region, the direst COVID-19 crises are, of course, in the fragile conflict states: Syria, Libya, and Yemen. There are encouraging developments in Egypt, Oman, and Iraq, but COVID-19 and the low rate of vaccinations increase the uncertainty and, at a minimum, create a drag on these economies. Where COVID-19 data is reliable, mortality rates have driven, even in countries with relatively high vaccination rates, such as Tunisia. The country now has the highest coronavirus mortality rate per capita in the MENA region and across Africa. Now, global vaccination efforts in the region have been obstructed by economic and logistical challenges, as poorer countries struggle to afford vaccines. Queue for vaccine supplies through the Global COVAX initiative and determine how to ensure the safe and effective distribution of vaccines, given that most vaccines need to be delivered through 2 shots and, of course, require cold storage. Wealthier countries in the region have led the inoculation efforts. The UAE, which launched its vaccination campaign at the end of December 2020, has been able to ensure that more than 80% of its population has received at least 1 dose. The UAE, Qatar, and Bahrain far outpace the world leaders in vaccination rates in Western countries, such as the US, Germany, and indeed the UK. Other Gulf states lag these leaders, but each has made significant progress in distributing the vaccine. Lower-income MENA countries are all relying on the COVAX facility, which is likely to face significant delays in the quarters ahead. This means that these countries are unlikely to vaccinate most of their priority populations before early 2022. Syria's vaccination rate is estimated at just 0.05%. There are no reliable numbers for Libya and Yemen. Moreover, in some countries, the efficacy of vaccination campaigns is being undermined by hesitancy among the public and disinformation about the risks of vaccination. Fighting the pandemic, mainly by vaccination, will be the most critical factor determining the speed of opening up of individual economies and the most vulnerable sectors such as tourism. While vaccines administered in the MENA region come from various suppliers, Chinese producers play the dominant role. Overall, the region struggles with limited access to vaccines, especially those produced in the US and Europe. Some countries, especially those affected by violent conflicts and political disintegration, lack the administrative and logistical capacity to conduct mass vaccinations. The Middle East and North Africa region, like many other parts of the world, remains stuck in a pandemic-induced economic crisis. The Delta variant and the slow uptick in vaccination rates in the MENA region increases the gap with advanced economies, which seem to have almost solved the vaccine access and distribution problems. This will likely again test public health systems and the resilience of economic growth strategies that rely on a large young population to sustain consumption. The projected weighted average economic growth for MENA is 3.3% in 2021. While this compares favorably to the 10-year historical average of 2.7%, it is still a relatively muted recovery, following an estimated 3.8% contraction in 2020. The World Bank estimates the accumulated cost of the pandemic in terms of GDP losses by the end of 2021 amounts to $227 billion. The anticipated rebound of close to 3% is hence unlikely to be strong enough to allow the region to regain the level of economic activity it had in 2019, and certainly not the level forecast before the pandemic. The rebound in oil prices to more than 10% above the fourth quarter 2019 average has helped improve the economic performance. But people-facing industries like travel and tourism remain subdued. Notably, accommodation and food services, transportation and entertainment are still struggling. Aside from muted economic growth, a series of recent exchange rate devaluations will put further near-term pressure on these economies, driving up inflationary pressures and eroding household purchasing power. The region's inflation-adjusted government revenues dropped by 24% in 2020. Iraq, for instance, devalued the dinar against the US dollar by 22.7% in December 2020 as part of an effort to mitigate the impact of the pandemic-induced oil price shock. Similarly, Lebanon's economic and political crisis have led to significant outflows of US dollars, leading to a widening divergence between official and parallel exchange rates, growing triple-digit inflation in recent months. Nonetheless, Egypt and Israel are the only two major MENA economies that will see their economies return to pre-COVID-19 levels in 2021. For the GCC, in contrast, fiscal consolidation will temper the pace of the country's economic rebound. While the Brent crude price forecast has been revised up from $53 per barrel at the start of the year to $64 per barrel on the back of the global economic recovery and the associated strengthening in energy demand, this still implies oil prices will continue to range well below three-digit levels seen before the 2014 oil price fall. Given that hydrocarbons make up between a fifth and 9/10 of total government revenue, fiscal restraint across the region is expected. One of the most lasting impacts of the crisis has been on sovereign debt, as the MENA region entered the COVID-19 crisis with enduring low growth and macroeconomic imbalances. The World Bank expects the region's public debt to rise from 46% of its GDP in 2019 to 54% by the end of 2021. This increase would be MENA's fastest accumulation of public debt as a share of output in the 21st century. The substantial borrowing that MENA governments had to incur to finance essential health and social protection measures increased government debt dramatically. The average public debt in MENA countries is expected to rise 8 percentage points, from about 46% of GDP in 2019 to 54% in 2021. Real government revenue last year was 24% less than the previous year, with the sharpest declines among the GCC and developing oil exporters. Not surprising given the oil price collapse. Squeezed by declining revenue, government expenditure in the MENA region also dropped compared to pre-pandemic expectations. Notably, debt among MENA oil importers is expected to average about 93% of GDP in 2021. Consequently, the region's average fiscal deficit in 2020 is estimated to be around 9.4% of GDP compared to the pre-pandemic forecast deficit of 4.6%. GCC countries have already begun to clamp down on spending and increasing tax collections in the past year in the wake of the oil price plunge. Saudi Arabia, for instance, suspended the cost of living allowances and tripled the 5% value-added tax in mid-2020. The UAE, meanwhile, put road tolls into effect for the first time as of January 2021. As such, MENA government's efforts to narrow their budget deficits will likely continue offering modest hindrances to growth. For instance, Saudi Arabia's 2021 budget plans to avoid a hike in public sector wages and envisions a 21.4% cut to subsidies over the year. Smaller GCC states are also following suit, with Oman, for instance, implementing the 5% VAT in April 2021 and committing to significant wage cuts to help maintain investor confidence. Taken together, these measures will partially offset the benefits of the early lifting of the pandemic-related measures and will dampen household purchasing power. The GCC states are generally in good shape relative to most major oil exporters and have more options at their disposal. Sovereign wealth fund buffers, for instance, will mitigate the impact of higher gross debt burdens for most GCC sovereigns. GCC countries' central banks and sovereign wealth funds own important foreign assets, providing them with a large liquidity cushion. Abu Dhabi, for instance, holds the world's fourth largest sovereign wealth fund, making it a net creditor at a global level. Saudi Arabia, the UAE, Kuwait, and Qatar all have ample room to draw on savings and to borrow. Oman and Bahrain are in weaker positions, but still have access to capital markets. Bahrain can probably count on aid as well, although it has become increasingly dependent on Saudi Arabia. In the long term, however, these funds are likely to become increasingly depleted, hence making it unsustainable. Maintaining high debt could also be risky in the long term, threatening economies' creditworthiness and their ability to refinance maturing debt in the future. These risks, if they materialize, can result in economic woes characterized by currency devaluations, runaway inflation, capital flight, and ultimately costly debt crises. Lebanon's debt default in March 2020 and the ongoing crisis is a painful example. MENA countries will have no choice but to continue spending on healthcare and social protection as long as the pandemic continues. Consequently, in a post-pandemic world, most MENA countries may find themselves trapped with debt service bills requiring resources that otherwise could be used for economic development and diversification from oil. This will ultimately add to already high debt burdens and lead to complicated policy decisions after the pandemic recedes. Default risk indicators for many MENA countries hence rose sharply during 2020, and some have not returned to pre-pandemic levels. This is probably because many MENA countries entered 2020 with high debt and chronic low growth relative to world peers. These pre-existing vulnerabilities might have heightened the long-term costs of public debt accumulation. Many MENA countries face borrowing costs higher than other economies, even though global interest rates are at historically low levels. In addition, high levels of debt may be accompanied by costly debt interest payments that gradually reduce the space for other growth-enhancing public investment opportunities. For example, a few countries in the MENA region already have interest payments equivalent to about 10% of GDP and account for more than 30% of total expenditures. However, oil revenues differentiate GCC and North African sovereign outlooks in the Gulf's favor. Hydrocarbon reserves allowed some GCC countries to build up significant net government and external asset positions, which supported the ratings as investment income flows to the budget and external accounts remained substantial following the sharp fall in oil prices. Even as hydrocarbon-related revenue actually contracted. Notably, Abu Dhabi's very strong fiscal positions reflect this dynamic. For both Egypt and Morocco, external debt exceeds liquid external assets, while in Saudi Arabia and the UAE, the high level of government assets, which are largely invested abroad, results in very strong external balance sheets. Going forward, I am particularly excited about Middle East foreign policy recalibration that should enhance economic cooperation. The regional rivalry between Turkey, Qatar, and the UAE has been a dominant theme in Middle Eastern politics, looming in the background of regional crises in Egypt, Syria, Libya, and Tunisia. Over the past few months, we have seen high-level meetings take place with the aim of mending these fences. The slow warming of Turkey, Qatar, and UAE relations will likely improve some aspects of the country's economies as they reinvest in one another. Turkey and the UAE now recognize that geopolitical tensions came at an economic price, heightened by the COVID-19 pandemic. With renewed access to Qatar following the lifting of the blockade, Emirati construction firms already appear ready to take advantage of the surge of projects that still need to be finished in Doha after the World Cup, which the city in Qatar is scheduled to host in November 2022. The warming of ties could also see the reopening of air links between Qatar and the UAE, which are key to connecting Doha to global tourism flows, given that Dubai's airports are the region's largest transport hubs. Increased cooperation may also eventually see the return of Qatari investors and consumers to the UAE for the first time since 2017. Qatari investors were once a major source of income for the UAE's real estate sector. Nonetheless, the full recovery of the country's pre-blockade business ties will likely take more time and require further effort by all sides to improve diplomatic relations. However, geostrategic pragmatism can only be temporary in nature. Political differences will be harder to overcome, as the fundamental ideological differences remain the foundation for regional competition between Turkey, Qatar, and the UAE. Moreover, the Taliban takeover of Afghanistan threatens to exacerbate regional divides and potentially upset delicate balances between the Gulf states, amongst whom relations remain fragile. Notably, should Qatar adopt a more dominant role as a regional power broker, it risks straining recently revived ties with other Gulf states, such as the UAE and Saudi Arabia. Gulf states will likely adopt a more pragmatic approach towards Taliban rule, whilst Saudi Arabia and the UAE will seek to use existing socio-religious and economic leverage to mitigate the threat of Islamist militancy. Overall, the Taliban takeover adds another layer to already complex and shifting regional dynamics in the wider region. Not only are these shifts likely to impact how states across the Gulf interact and trade with each other, creating some uncertainty for businesses, but recent developments will also fuel concerns over the potential for renewed attacks from extremist actors. At Pangea-Risk, we have been monitoring the Middle East and North African region in terms of key political, security and economic developments that could drive emerging threats and create fresh opportunities for export and project finance investments. As the MENA region increasingly becomes centered on South-South trade collaboration, the macroeconomic outlook becomes increasingly complex. Trends in MENA need to be seen in the context of what is happening in Africa, South Asia, and indeed China. On that basis, there is still a lot more to talk about. So, if you do have any questions or comments, please feel free to contact us and reach out at our email address insight@pangea-risk.com. In the meantime, that is it from me, and I hope to see you all again very soon. Thank you for listening and stay safe.